I would highly recommend to sell your TFSA portfolio when you are moving out of Canada to US, because first of all that would result in additional filing requirements. All the income that you are earning in TFSA will be taxable in US, but also the tax-free benefit that you had while you were resident of Canada, you would essentially lose it when you sell that stock because there is no deemed disposition. Take example of mutual fund. It is considered the very basic investment tool which is given to the beginner investors, but that innocent looking tool might be a huge problem for you when you are in US, because in many situations that would be considered as PFIG with additional reporting requirements, and that might be quite messy. People might think that as long as they file their 1040s, they are good enough from their filing requirements. But not just that, there are other requirements as well. You have to file some reports to FinCEN, which is a anti-money laundering unit of US, and you might have those requirements as well. Usually, if you are an ex-Canadian who have moved to US, you might have some accounts. There's a very high probability that you will fall under those thresholds, and you have to do those additional filings, which are in addition to your tax returns, and the penalties are quite harsh on.
Hello friends, my name is Behroz and welcome to my channel. In today's podcast, my friend Aamir Jewani, a cross-border tax expert, will discuss managing your Canadian investments when moving to the US. Personally, I rely on Aamir for everything related to Canadian and US taxation, especially cross-border matters, as I've gone through this process myself. There are many nuances to handling different investment accounts when you leave Canada. For example, unregistered accounts, FHSA, TFSA, RESP, and RRSP all have unique treatments when you're leaving Canada. Once you're in the US, the rules and tax implications change entirely. It's essential to understand these treatments to make informed decisions. Should you hold on to these investments? Should you sell them? Or should you liquidate the accounts entirely? Aamir dives into all this in today's episode. If you need help with tax-related matters, I highly recommend Aamir's services. I've personally benefited from his expertise. You can access his tax consultancy services using the link in the description of this video. Please note, it's a paid link, but using it gives you a 30% discount. Additionally, whatever you pay can be credited towards future tax filing services with Aamir. Now, before we jump into the podcast, I have one small request. If you find any value in this video, please take a moment to hit the like button and subscribe to the channel. Your support motivates me to create more content like this. So without further delay, let's dive into the podcast. Thank you, Aamir. Thank you for joining again. So in today's video, what I would want to touch upon with you is the treatment of key investment accounts, especially when there is investment in equities and bonds that I have in Canada and I'm moving to US, for example, and that's what happened with me as well. So there are certain accounts where I had some investments, call it TFSA, call it RRSP, RESP, and the newly created account FHSA as well, although I didn't have any investment there because it's pretty new and I moved before that. Plus, there is unregistered accounts as well, the investments that I have in equities and bonds, which are in unregistered accounts. So I want to understand the treatment of those accounts, those investments, once I move to US. So what happens at the time of exit? And once I move to US, how would these accounts be treated if they are still alive? And what is the guidance with regards to managing these accounts? So, but before going into all these details, if you can quickly introduce yourself, why are you the right person? Because I use your services, I use your advice a lot in these matters because I've moved myself from Canada to US and I seek your services. But it would be nice to hear from you. Why are you the right person to talk about all this? And then we'll go into the questions specific to all of these accounts. So over to you, Amir.
Thanks, Behroz. So for your viewers, my name is Aamir Jewani, and I'm an accountant and tax consultant. Particularly, my niche is cross-border taxes, because we do taxes both in Canada and US. So that's where we can provide a value addition to our clients, especially those clients who have some part of their tax obligations in US or Canada, or they want to claim some tax credits or something like that. That's where our advice can come really handy. Generally, we operate in Canada, US, and UAE, and we provide tax services to individuals as well as businesses, plus bookkeeping, payroll, company formation, and all that stuff.
Thank you, Amir. So let's start rolling into it. So first question is related to unregistered account. let's say I have some investments, some stocks that I have purchased that are in the unregistered accounts. There is capital gain there, unrealized, plus there is dividend income that I earn in that account as well. So when I'm leaving Canada, how should I treat that account, and then how is that account treated in US?
Okay. So, like many other assets, unregistered accounts will be subject to your departure tax. So, when you are leaving, as we discussed in our earlier videos, that when you are leaving the country, and if your total fair market value of your assets is more than $25,000 in total, then you need to file a form in which you declare all your assets worldwide and their market value. And then some of them are excluded from the departure taxes, but your unregistered accounts would be the ones which will be subject to departure tax. So that would be based on whatever is the capital gain on that date. So basically, government will assume that on that date, when you became non-resident, you sold those shares and immediately bought them again, which is called deemed disposition. So whatever comes out as per the tax laws as your capital gain, you will pay tax on that. And because you pay tax on that, when you move to Canada, when you move to US from Canada, from US perspective, that's your starting point. So if you bought something for $10 on the date of becoming non-resident, that was, let's say, 15. So your $5 was the capital gain, and then there would be some part of it which is taxable capital gain. You will pay tax on that. But from US perspective, now your starting point is 15. Your cost is 15, and then let's suppose you sell it for 18, then 3 is your capital gain in US.
Okay, got it. Very clear. So whatever is the price of your stocks on the date you are moving out of Canada, you assume that on that price you've sold, and then you pay taxes based on the capital gain, as you said, from 10 to 15. And then 15 becomes the new cost basis for any future capital gain that may happen that you realize when you're in US. So this is very clear.
Yes.
So which is, let's say if the stock moves from 15 to 20 while you're living in US, then you only have to pay tax on that $5 capital gain, not the $10 starting from 10. Second is, what if you are earning dividend income on your equities or stocks or interest income in the unregistered account? How is that treated once you are in US?
Okay, so once you are in US, assuming that those dividends, or I mean those stocks are held with a brokerage in Canada, so when you move out of Canada, you will tell them that you are a non-resident. And once you tell them that you are a non-resident, and particularly that when you are a US non-resident, they are, so generally speaking, for now, ignore about US. So generally speaking, when you tell any financial institution that you are a non-resident, they are supposed to withhold 25% of whatever income you are getting. So that's a general rule. A non-resident getting any income, the payer who is Canadian must deduct 25%, which is called withholding tax, pay it to the government, and pay remaining amount to you. Generally, that's a final liability, and then you are not really required to file any taxes. But if you think you have paid too much and you want to get a refund, and there's some reason that you have paid too much, you can obviously file a return and get the remaining amount back. Um, Specifically in case of US, because there's a treaty and the withholding rate is reduced to 15% for dividends. So if you tell your institution that you are non-resident and you are a US resident, they will ask your details and then they will withhold only 15%. Most of the financial institutions have that capability. But let's suppose if due to whatever reason, for somehow they withheld 25%, then you will file a return and you will give this argument. I mean, in that return, you will mention that you are a US resident and your treaty rate is 15%, and then you can get the 10% back.
Okay, and this is on side of Canada, but in
Oh,
US.
yeah, sorry. That's Canadian side. US side, that's part of your worldwide income. If you are a US resident or citizen, you need to declare your worldwide income. So again, you will declare that in your tax returns in US. And it won't be a double taxation because eventually the taxes you have paid in Canada on that income will be used as a foreign tax credit. And generally, assuming Canadian tax rate is higher, you might not have to pay anything extra. But theoretically, for whatsoever reason, if your US tax rate is higher for some reason, then you might have to pay extra in US.
Amir, thank you for sharing the details on unregistered account. One question I have is, can I trade with my stocks or equities or bonds that I have in my unregistered account, can I like buy and sell with the money I have? So even if I don't, or maybe I can choose to contribute more in the unregistered account. So can I contribute more in the unregistered account? Plus, can I trade using the money that I have in the unregistered account?
No, you can sell for sure, but you cannot buy, and that's a Canadian thing. And most of the brokerage would not even allow you to do it once you tell them you are non-registered.
So essentially, if ever I want to buy, I can only buy in US with a US broker. So, but I can sell with the stocks that I have in the Canadian broker. Got it. Got it. Very clear. Okay, let's move into RRSP then. So in RRSP, typically when I invest in RRSP, I get a tax credit. Like I don't pay tax on the amount that I contribute in RRSP in Canada. And then if there are any capital gains that happen, whether realized or unrealized, as long as they are within RRSP, I don't pay any tax on it either. And if there is any dividend income, I don't pay any tax on that dividend income as well, as long as the amount is within RRSP account and I like amount is there and I don't take it out. So what happens when I'm leaving Canada to the value or the investments that I have in the RRSP account, and what happens to those gains unrealized or that dividend income once I move to US?
Okay, so before coming to RRSP, a general concept from US perspective. USA has a concept of a trust or foreign grantor trust. So most of these tax deferred or tax advantage investments that we do, RRSP, TFSA, FHSA, they are from US tax perspective, that is an example of a foreign trust, right? So that is something we have to keep in mind in the background, because when we'll discuss that will impact how your US taxes are done. But coming specifically to RRSP, on Canadian side, obviously, it can grow tax free when even when you become non-resident. You cannot contribute further once you become non-resident. So it is very important that you make sure that there are no pre-authorized debits or stuff like that going on after you become non-resident, because the penalty is 1% per month and it goes on, right? So and it can be even retrospective. If you tell CRA, it happened actually to one of my clients. She told CRA after 10 years that she was a non-resident since 2011. She told that in 2022. um, she had got like $1,000 only once $1,000 deposited into her. In this case, it was TFSA, and then that 1% per month was $100, and for 12 years or 10 years, that came out to be more than $10,000 or $12,000. So that was a huge penalty for her just for that, ignoring that $1,000 were paid out of pre-authorized debit. So it is very important. Well, in that case, we eventually got that removed. But in this case, it is very important that no pre-authorized debit or no contribution once you became non-resident. So it can grow tax-free. You cannot contribute further. Um, and when you take the money out, as I said, that it's generally for non-resident is 25% withholding on the withdrawal, which is your final tax liability. But for US residents, due to tax treaty, it is 15%. There's a possibility it might be a different rate for different countries depending where you are resident. But the general rule is non-residents, 25% they will withhold and 75% they will pay you. No tax return is required unless you want to get some refund or you think you will get some refund. And another important part of that RRSP is that if you have taken a home buying loan within RRSP and you became non-resident, so within 60 days, either you have to pay that loan or in your final tax return, that becomes your income. So you have to consider that either you have to take the cash out or and pay to CRA and pay within your RRSP, or if you don't want to do that, then that will be part of your income and that will affect your taxes or tax planning for that year. So that's the Canadian side. On the US side, the good thing is they also consider, due to Canada-US tax treaty, they also consider it as a tax deferred plan, and there is no taxation until the assets grow within the plan, right? So just like Canada, for on our US tax side as well, we will not have to declare that income. We will not have to pay any tax on that income as long as it stays within the umbrella of RRSP. Previously, US persons who had RRSP, they were supposed to file a form 8891, but now that requirement is removed. The only situation where RRSP will become taxable for you is when you withdraw. And when you withdraw, it would be treated as just like any other income, depending on what was the nature of that income within RRSP. And just like how it would have been treated for an unregistered account, it would be treated like that. So withdrawal is same. While it's growing, it is still tax-free even for US person. Um, but that is on a federal side. So from federal perspective, it's tax-free growth. From state perspective, however, it varies. There are states like New Jersey or California who do not honor who do not recognize US-Canada tax treaty. So because of that, for them, even RRSP is income, and that you need to declare and you need to pay tax on that. So if you are in one of those states, you need to not only consider the federal level state planning, but also federal level tax planning, but also state level tax planning.
Right. And can you trade in that account? Like if I have stocks, can I sell and then with the same money can I buy now when I'm living in US? But the account is in Canada, it's a RRSP account, so can I trade within the account? Is there any implication or no?
If you are trading, that should be okay. I mean, as long as it remains within that. So for example, if I have a web broker account of TD and I have certain funds within that, which is under the RRSP umbrella, obviously I can sell, buy, I can do whatever as long as it remains within RRSP umbrella. And even if you transfer from one institution to another, as long as it is direct transfer, that should be okay. So whatever rules apply in Canada, they remain same even when you move to US.
And in case of the states where it is not recognized and there might be state tax implication, what is the advice? Like what happens to my RRSP? Like should I close it, sell it off, or should I keep it? Will there be deemed disposition on it as well? Because if there is deemed disposition, it's still not bad. But if there won't be deemed disposition, there might be a different treatment altogether. Then I'm not sure if it would be advisable to keep holding it. So any thoughts on that?
Okay, if you are moving into one of those states where they don't recognize the treaty and RRSP is taxable, more often than not, we will suggest to liquidate the RRSP. And the reason is for your non-registered investments, you still have a foreign tax credit available because you would have paid some tax in Canada, right? Here it won't have that. So you would have same limitations like you would have, plus it would further complicate the matter when you actually withdraw from RRSP, because a state level tax you have already paid, and now when you withdraw you have to pay federal, and then that becomes a bit messy. So generally we suggest to liquidate it if you are moving to one of those states. And what was the second question?
No, this was the question I had. Okay. Now let's move to TFSA.
Okay.
How is TFSA treated? And again, similar to that, what would be the treatment in Canada, treatment in US, and what is the advice whether to keep it or liquidate it?
For TFSA, it's pretty much similar like RRSP from Canadian side. Growth is tax free. You cannot contribute. And when I say you cannot contribute after becoming non-resident, it's the very date that you tell CRA that I became non-resident. If you tell them 15 March 2024 I'm non-resident, then from that date onwards you cannot contribute. You can withdraw money from TFSA. Obviously, it's tax free from Canadian perspective. Um, but and that will add to the room. So the room available is, let's say, 5,000. You withdraw 2,000. Your room is now 7,000. But unfortunately, you cannot use that room again until you become a resident again, because contribution is not allowed. Um, Another thing is that for the years you were a non-resident, your room will not add up generally. Like every year, that contribution room increases because every year they give an amount 5,000, 6,000, 6,500. So that does not apply to you in those years. And that is where we see a lot of errors or penalties, because you moved to US, you remained there 3 years, you came back again. Now you went to a financial advisor, which was a different one. They didn't know about your history that you were in US. You didn't tell because you didn't think it was relevant, and they calculated your room based on all those years. They just asked you when you came to Canada or when you became resident. You said 2020, and then they calculated everything. But the fact that you were not a Canadian resident for 2 years, you should not have included that. So that's a very common mistake we see on the Canadian side, but that is the situation when you have become a resident again. That is something we should keep in mind. So that's from Canadian side. From US side, as I mentioned in the beginning of the video, that all these tax advantage investments are considered a form of a trust, because just like trust, um, in trust, the investments are within an umbrella and you have some control on it, but not the complete control on it. So that's why they are considered as a foreign trust and often a foreign grantor trust from US tax perspective, right? So it was not a problem in RRSP on federal level because that was recognized as a tax advantage vehicle and they were recognizing it. But in case of TFSA, neither federal nor state level taxation recognize TFSA as tax advantage plan. So that would mean, first of all, the income that you would earn under that TFSA, whatever is the growth, that will be taxable in Canada or in US. That will be taxable in US. So income you have to report, you have to pay tax on that. That's the major thing. And obviously, when you pay that on that income, then that's done. From another thing you have to consider is that not just income tax is one consideration. Obviously, that is a bigger consideration, but additional reporting will also be required because now that it is considered a trust, there are additional reportings like Form 3520 and 3528 that you need to file, which are for a foreign trust, and they are not easy forms. They have a lot more information that you need to provide, and most of the time, people who are holding TFSA might not have that information even easily available. Yes, you can get it from your broker in other places, but then that's additional compliance, additional cost, and if you miss it, additional penalty. So normally, if people are moving out of Canada to US, we suggest to liquidate their TFSA because it defeats the purpose of holding a TFSA. It's not tax free for you anymore, so doesn't really help that cause.
Got it. And what about the capital gains once I'm in US? So I didn't close the account, I keep the account as is. And in Canada, if there is capital gain, trade within the
Yeah,
account. I don't pay any tax on it, and I can take out the money tax free. What happens if there
yeah.
are capital gains when even when the money is within the account, there is capital gain within the
Mhm.
account? What happens?
Okay, so unfortunately, in capital gain, you don't get a step. Just like in RRSP, you do get a step up. Here, you don't get a step up. The reason is step up is there when there's a deemed disposition. In this case, there was no deemed disposition, so there is no step up, which means that if you bought something for $10, when you moved out of Canada, it was 15, and when you sold, it was 18. So it's a still $8 gain from US perspective, not three. Because in any other form of investment, it would not matter because you would have paid the foreign tax on that on the Canadian side that would have offsetted it, but that cannot happen here. So it doesn't really give any advantage if you plan to be there in US and holding the TFSA.
So not just that it doesn't give any advantage, rather you lose all the advantage that you've built, right? So let's say I had $10,000 I invested in TFSA. Over the period of time I was in Canada, the money increased to become $50,000. Now
Hmm.
this all 40,000 gain is tax free. I can take it out. But if I choose not to take it out, I move to US. Now if the if the investment doesn't move at all, like if it stays at $50,000, and if I have to liquidate it, I have to pay capital gain tax on those $40,000. So those $40,000 that were cap tax free till the date I moved out of, till the date I was in Canada, they were tax free. The day I move out of Canada and I have not liquidated TFSA account, I have to pay tax on it. So I lose all the benefit that I've gathered over the years,
From day one.
which means I think the
Uh,
advice would be to liquidate TFSA then.
Yeah. What some people do is, if they really want to keep those keep those stocks or whatever it is, what some people do is they sell it just before becoming non-resident and buy it again. It's tax neutral from Canadian perspective using their same contribution room. Obviously, you have to follow the contribution room rules as well. So somehow you have to place it somewhere around end of the year. But that's what some people do. So that's how they kind of instead of deemed disposition, they kind of actually dispose it and buy it again. So that from US perspective, it is a fresh stocks or whatever it is. But in that also you have to consider US has what is called washout rules. There are rules for the stocks that if you just buy and same stock within certain period of time with certain conditions met, they assume that you have never sold it. So you have to not just you have to see the Canadian side of it, you have to see the US side.
Got it. Very clear. Thank you. Now let's move to RESP.
Hmm.
How is RESP treated up till the time I am in Canada? So on my date of exit, and then how does it get treated? Any capital gains and income in RESP? And then later I will also ask you about how to make use of RESP with whatever funds are there. But for now, let's talk about RESP the day I'm leaving and RESP after that. Capital gains and income.
Okay, when you are leaving when you are leaving Canada, RESP is again one of the excluded portion, and you won't pay any tax on that, any departure tax. Once you have left Canada, so let's talk from US and Canadian perspective. From US perspective, that income is again taxable, just like TFSA. They don't recognize tax-free nature of RESP, and just like TFSA, it is also considered part of a foreign trust. So all those reporting requirements will be applicable. Um, Distribution from RESP, whether that is for educational purposes or not, it is taxable to beneficiary or the subscriber, depending on who IRS deems to be the owner of income. So just to clarify, in case of RESP, if I'm contributing the money, I'm subscriber. And let's suppose if that money is used for my kid's education, he is the beneficiary. So from US perspective, IRS will decide who is owner of the income and then they will tax that person. Even in Canadian perspective, assuming you are not a Canadian non-resident, if you live in Canada, you have an RESP, and when you use that RESP for your kids' education, it is still taxable. I'll come to the specific parts, but it is still taxable, and but it is taxable to the kid. But it is assumed that the kid will have tuition credits for that education, plus that would be lower income, and he would take that money out over the period of 4 years. So net would be too less, and then there would not be any tax implication. But theoretically, it is taxable to the beneficiary. So same treatment is there in US side as well when you take the money out. Um, but let's go into the components of RESP. So when you put money into RESP and it grows over time and eventually you use it for your kids' education, the money that your kid will take out will have three portions. First of all, it has the money which you put from your pocket, which was your after-tax money. That doesn't get taxed anywhere. US, Canada, resident, non-resident, doesn't matter. It is not taxable. The second portion is government grant that government has given you, right, which is called CESG, or it has some different names. But there's a portion which government kind of matches your contribution up to certain percentage. That is a government grant portion of your that RESP pool of money. And the third is investment growth. So this government grant and the income growth is called EAP, Educational Assessment Payments. So when you take this portion out, that is taxable to the beneficiary in Canada, and then IRS will decide if that is more relevant to the beneficiary or more relevant to the owner. But it becomes a bit messy when you had an RESP, you move to Canada, you move to US from Canada, and now you think that you want your son to use it. Because one of the requirement to use it and to be considered as its true use is that the person who is using it should use it for the educational purposes, obviously, but that person should also be a resident in Canada, because Canada is going to tax that beneficiary for that EAP portion. If that person is not a resident, Canada cannot tax that beneficiary as an EAP. So if you use that money and that person is not a resident, so then Canada will assume it is a non-educational withdrawal of that income, right? And when it is a non-education withdrawal, it is not only subject to income tax, it is also subject to 20% penalty unless it is transferred to an RRSP. And again, because you are a non-resident, you cannot transfer it to an RRSP. So that really limits your option if you retain your RESP and you are in US. Obviously, we are not financial advisors. Probably financial advisors can give you more strategies into that. But from tax perspective, um, it's difficult logistically to utilize RESP for its actual purpose because of that residence requirement. Well, you can meet it, but then it becomes a bit tricky. So that we have to consider. And also we have to consider from US perspective, it is an income which is taxable. It is a trust. So trust requires some additional reporting requirements.
So, would you advise that if I plan not to move back to Canada, or I plan not to educate my kids in Canada altogether, then it's best to close it when I'm exiting and not to keep it because it would be of no use and it would be of more pain?
Yes, because see, if we look at overall, um, I would say sentiments or mood of US tax over last 6, 7, or 10 years, it has become a very harsh in terms of foreign assets, foreign investments, foreign passive investments, right? And due to one reason or other, it does affect all these TFSAs and RESPs, and that is going to get worse. Not only in terms of how you can use it, but also additional reportings that you have to do, and they are very harsh penalties when you miss those reportings. And it's very easy to forget because a lot of people would think, oh, TFS is not taxable. I mean, if you have lived in Canada for 10, 15 years, that's kind of built into your brain that, okay, TFS is not taxable. I don't even declare it in my T1. And then when you go to your local tax person in US, he would ask, do you have any investment? You might not even think of TFSA because for throughout your life 10, 15 years you were in Canada, you never declared in T1. You don't thought it as something that needs to be declared. So it's very easy to miss that.
Got it. Okay, let's move to the last account, which is FHSA. What about that?
Okay, so just to give you a background of what FHSA is, it's a new initiative by government to promote or help people save more for those who want to buy their first home, right? So they kind of try to combine the benefits of RRSP and TFSA. So like RRSP, it is tax deductible. Like TFSA, the growth is tax free. But the purpose is you have to buy it is for to buy your first home, and you can use it anytime within the next 15 years. So there is enough flexibility in terms of time. Um, and you can also convert it to your RRSP or TFSA. So it's quite a flexible account till the time you are in Canada. The limit is 8,000 per year, 40,000 lifetime. From so if you are in Canada, it's a great way to save money for your house. That will help. But from US side, as soon as you move, you become a non-resident of Canada. By the way, this is a theoretical discussion for now because this just introduced last year, and I haven't come across a person who got FHSA last year and moved to US this year. So maybe in few years we will see those situations where people might change their mind and move to US while they have saved money under FHSA for their first home. So from US perspective, again, just like TFSA or RESP, it is not tax deferred or tax exempt. So that would mean you have to pay tax on that income. And because when you are leaving Canada, you have not paid any deemed disposition on that. And because it is not part of US Canada tax treaty, so eventually you will pay the capital gain if depending on what you have invested in. But if there's a capital gain, you will pay based on the actual cost. So just like TFSA, you would lose that benefit as well. Um, the contribution that you make to FHSA is not tax deductible. It is deductible in Canada, but not in US because they don't recognize that as that tax advantage tool, and earnings are taxable. So again, no benefit as such if you are in US.
Okay, got it. Very clear. So, which means again, like TFSA, it's best to liquidate it and close the account as against keeping it and then paying tax on a higher on a lower base with a higher capital gain.
That's
Got it.
true.
Thank you. Okay, now let's quickly move into the reporting requirements, which is you did mention a few for each
Mhm.
different type TFSA, RRSP, and all. But then there is one wholesome reporting requirement as well, which
Yeah,
you wanted to call out. So if you can share that as well with us.
sure, sure. So besides the reporting requirements which are related to trust, which we mentioned, and reporting requirements related to PFIC. Generally, if you are a US person, doesn't matter whether you came from Canada or wherever you came from, or if you never were a resident or citizen of any other country, you always lived your life in US. But generally, if you have a foreign bank account, and bank account is a very broad definition that doesn't just means a bank account, that's financial account. So which might include your investment accounts, which might include your, crypto wallets, anything like that. So any financial account which you own or where you have a signing authority, right? So you might have a corporation which has the account and you have a signing authority in that corporation. Most of the situation, there are some exceptions for that signing authority, but generally if you own or you have a signing authority over a financial account which is outside US, so foreign from US perspective, and the cumulative total balance in those accounts cumulative is more than $10,000 any time in the year, that is subject to what is called FBAR reporting, right? And not doing so as penalty in thousands of dollars, like 5,000, 10,000, and onward. It's a big number. So we have to understand that FBAR is not a IRS requirement, right? IRS is the tax body where we pay our taxes. We declare our income, we pay our taxes, right? They are concerned about taxes. FBAR is FinCEN requirement. FinCEN is their money laundering watchdog, which takes care of whether people in our country have money from secure sources or not. There's no money laundering or stuff like that. So just because they are their perspective is money laundering, their penalties are much harsh. They don't want people to miss it, right? But it is one of the most commonly missed reporting because it does not go with your tax return. So if you walk into your, in your neighborhood into a typical, tax office and you tell them, okay, I need to file my tax return. Here's my W-2, my 1099. They would, take it into, especially in the busy season, they would take information, put in software, run the report. Here is your return. You will file it and you would think that everything is done. But FBAR is a separate reporting to FinCEN, right? Most of the tax softwares have an option to file that, and tax preparers should ask it, but sometimes they would miss it as well. So that's why if you have that requirement, you need to know and you need to remind your tax preparer that are you also doing FBAR or am I supposed to do separately? So FBAR is an important requirement. Financial accounts more than $10,000 aggregate, and if it is aggregate more than 10,000, then you need to declare all your financial account, not just those which were above 10,000, but all your accounts. And it is a bit detailed. You have to mention even the location of the bank, where it is, the branch location, account number, and stuff like that. So it's quite a, I would say, intrusive report. You need to give a lot of information. So coming back to our context, where we are talking about the people who have moved from Canada to US, 10,000 US dollar is no big deal, right? Most of the people will have that one way or the other, especially if they are maintaining a house which is, rented or some reason they might have it. And the requirement is even if that was there for one single day, you have to do it. So, if you think that you have sold everything in Canada and you have moved to US, but for one day because you sold your house, the money moved through your bank account and then you transferred to US, still it's more than $10,000, right? So that is one important requirement that you have. And again, it has same deadline as your tax return, 15 April and with extension 15 October. But that is separate from your tax return. So it is advised to the viewers that you should, ensure that that is done. Another requirement is Form 8938, and that form is part of your tax return. It has a different threshold, and the threshold depends on two factors: what is your filing status, and whether you were living in the US or you were living outside the US. For example, if you were living in US or you were married, filing separate or single, the requirement is $50,000 on the last day or $75,000 anytime during the year. Okay. If you are married filing jointly, the requirement is 100,000 on the last day or 150,000 any time of the year. That is for people living in US. So if you are living in US and any of your foreign account had this much of movement or balance, you have to file that additional form 8938, which is part of your tax return. And likewise, there are different numbers if you are living abroad, and which are much higher because obviously it is anticipated that if you're living outside US, you would have more money in your account. So instead of 50 and 75,000, that's 200 and 300,000. And instead of 100,000 and 150,000 for married filing jointly, it's 400,000 and 600,000.
Got it, very clear. And thanks for sharing all this, because I know this is very important. It happened to me as well. By the way, now I'm recalling, I think I only did it for my bank accounts and not for my investment accounts, the FBAR form. And maybe that is something that I will need to probably check with you after this podcast and get that done as well. Thank you, Amir. Thank you for sharing this. So, the last part that I want to discuss with you is around mutual funds. So, up till now, it's all about if I have investments in these registered, unregistered accounts within equities and bonds. That is one way of treatment. What if my investments are in mutual funds? Is the treatment same or is it different?
Okay, so mutual fund is more tricky because if you have invested, especially within those RRS, within those TFSA, RESP, or FHSA, if you have invested in a mutual fund, so there is a very high likelihood that that might be classified under US tax law as PFIC, which is a passive foreign investment. So, and that is taxed quite harshly from US tax perspective. Not just taxed quite harshly, there are additional filing requirements as well, and it's very easy to forget, very easy to miss, because we would think that that is the simplest form of investment, which is mutual fund, which is usually, when there's a new investor, the first thing advisor would recommend is to start with a mutual fund, right? We thought that's a very basic investment, but given the fact it's part of a trust from US perspective within RESP or FHSA or TFSA, and given the fact that within that trust there is an investment into a mutual fund, that somehow gets qualified into PFIC, and so we have to be careful about that.
Got it. Thank you, Amit. Thanks for joining and thanks for sharing all this information and knowledge. If anyone wants to seek your services, reach out to you with more questions. I will leave the link on how they can book time on your calendar in the description of this video, and they can check it out. Thank you for joining and thank you for sharing all this knowledge.
Okay, thank you.